Hello and welcome to Off the Books, where we surf the uncharted waters of accounting, finance, risk, and wherever else the waves take us. This episode is brought to you by Workiva, the one platform that unites financial reporting, ESG, audit, and risk teams, which makes Workiva kind of special, like the University of Colorado's win over last year's college football national championship runner-ups. My name is Steve Soder, accounting enthusiast and Diet Coke aficionado. I'm looking forward to debating a great conversation, and I'm so happy to have you with us. I'm also happy to have Catherine Tsai joining us. Catherine, can you please tell everyone about yourself?
Golly, I'm not an accountant or Diet Coke aficionado, but I like asking questions and learning new things, so I'm here to do more of that.
And today we'll be talking about SPACs.
Special Purpose Acquisition Companies.
Yeah, that's right, Catherine. Often called a blank check company, a SPAC goes public, it raises funds, and then it uses those funds to acquire an existing company, which is the entity that operates going forward. But if the SPAC doesn't find a suitable target, it ends up unwinding and the investors get their money back. And we're talking about it because over the summer, an audit firm was fined millions of dollars and penalized for not doing such a great job of auditing SPACs, or other clients for that matter. And more recently, in September, the SEC charged the former National Assurance Services leader at that audit firm over those very deficiencies.
I wasn't even familiar with this particular firm until I heard about the penalties and the fines this summer. But Steve and I asked Bloomberg reporter and former Off the Books guest Nicola White all about them.
That's right, and let's get to that conversation and over to Nicola.
Hi, Steve. Hi, Catherine.
It's great to have you here.
Yeah, great to have you back.
Thank you so much for inviting me again.
Earlier this year, there was an audit firm that happened to have a lot of SPACs as clients that got in some trouble with the Public Company Accounting Oversight Board, or PCAOB. Can you refresh our memories on that?
Sure. And it also got in trouble with the SEC, the Securities and Exchange Commission. So you kind of have to backtrack a little bit to the heyday of SPACs, and that would have been 2020 and in particular 2021. If you think about it, we were all kind of like at home still. Interest rates were really low. There was, meme stock frenzies. There was just a lot of money sloshing around. And in order to go public, you need an auditor. So there were hundreds of these, people with basically bags of money that needed to go public, and they needed audits. And two audit firms basically dominated the market. They were like, we will specialize, well, not specialize, but like we have the market cornered on SPAC IPO audits. And one of them was Marcum. And Marcum basically, did hundreds of these SPAC just hundreds of SPAC audits. And, the market for SPACs, as we know now, did not go so great. Like there was the boom years, and then there was a bit of a bust. So the SEC and the PCAOB went back to the beginning, and they were like, Marcum, you took on too many clients too quickly. You did not have enough quality control procedures in place. It was like a litany of charges against the firm, and the firm, settled the charges without admitting or denying fault, and agreed to make a bunch of changes. So it was a pretty big deal, pretty big development in the milestone of the SPAC boom and bust. The auditors are the gatekeepers of one of the gatekeepers of our financial system. So regulators really care what auditors do or don't do.
Well, maybe in a separate conversation, we can talk about the failed off-the-books SPAC merger. It didn't go so great. We had all kinds of issues, but maybe we move beyond that. Of course, I'm joking. Nicola, tell us a little bit about the penalty, and even besides the penalty. Presumably, this is a big firm. I mean, I'm guessing the penalty hurts, but it sounds like there were also some potential downstream consequences of that as well.
Yeah. Well, first off, no firm likes to have its name in the headlines, right? So I should say that Marcum is not known as only a SPAC auditor. Like they have a diverse practice. If they're a solid mid-sized firm, and they've grown a lot in the past few years. So yeah, getting your name in the headlines is no good $13 million total penalty. But then, the charges were quite long, and they talked about, quote, systemic failures throughout the firm. And they didn't just say like, oh, you messed up SPAC audits. They were like, the amount of work that you put on your partners compounded pre-existing problems. So that's one thing. But one of the things that Markham had to agree to was hiring an independent consultant. And that independent consultant would have to make a lot of recommendations so that the firm could basically correct a bunch of the things that the SEC and the PCAOB said that they didn't do adequately. Make recommendations, and then vet them with the SEC and the PCAOB, which again, having a regulator involved in your day-to-day business, that's pretty onerous. But I think one of the most significant, or maybe the most significant penalty that they got, and this is a little bit buried because it's not $13 million, but Markham agreed to only take on 3 new clients every quarter until they remedy all of their problems. And, for an audit firm, that's an audit firm in particular that has been growing over the years. That's pretty serious, in my opinion.
That's crazy. I mean, just my experience has been, as an audit firm, you're going to have natural churn. Companies are going to get acquired. They're going to have varying audit needs or whatever. Only 3 a quarter. And you're going to keep going out to bid for these new clients. You're like, well, hey, we could do this job, but only if you pass the threshold of being one of the only 3 a quarter that we take. That's nuts.
Yeah, that's really, really hard. So I think that's, and I think it kind of goes to you went out too hard during the SPAC party years, like the SEC and the PCAOB reining them in a little bit, saying, you can't take on hundreds of clients in 1 year. And it wasn't even just hundreds of clients in 1 year. They took on more than 150 clients in 1 month in March 2021, or was it either February or March 2021. And the SEC pointed that out. Not everything the SEC puts out is juicy reading material, but this one, there was some good stuff in it. And one of the things, they had a quote from a partner saying, I guess they got it from an email that was sent inside the firm. And again, this is public record. It said, partners are working 90-hour work weeks, and they're at their breaking point, and they need more resources. And the SEC, in the next sentence said they added more than 150 new clients the next month. They added 3 more partners to that office. It went from 13 to 16. Not enough to really be, not working 90-hour weeks. I know some people do that, but you can't sustain that kind of pace. And in the PCAOB order, they had, the PCAOB order was very similar to the SEC one. But the PCAOB order had an example of a partner working 100-hour work weeks, which I have a hard time fathoming that. That sounds very, very hard. There is an accountant shortage, and that is a CPA shortage, I should say. And that is being reported constantly all over the place. It's hard to find accountants for a variety of reasons. And that's, when you have a high workload and not a lot of people, what happens? Well, we see what happens. So in Markham's case, and in every audit firm that took on SPACs, there was a pervasive accounting error that everybody got wrong, dealing with warrants, which are money-raising tools that were ubiquitous in SPAC purchases, SPAC deals, I should say. And almost every audit firm got the accounting wrong, and that came down from an SEC staff announcement that got dropped in April 2021. So, but because Markham and another firm with them had the corner on the SPAC market, it was a disproportionate number of their clients had to do restatements, And when you're dealing with restatements, your filings get delayed because you're like, I got to deal with this restatement. So your next 10Q deadline, you miss it. So it just kind of like adds more paperwork. So there was just so much going on.
Do we have any early senses for how Markham has reacted to this, or how things have changed, or has it been relatively quiet?
Yeah, I mean, officially, Markham put out a statement after all of the charges, and said it's committed to being on the up and up and changing X, Y, Z, and being professional and increasing audit quality, etc. But they haven't said like. I think it'll be interesting to see their annual reports to see how like revenues change, if anything. Might take maybe another year for that to get to kick in. But yeah, that the adding, not being able to add new audit clients is a pretty harsh penalty.
What if you're an existing Markham client and you're a SPAC? What are you thinking right now? Are you sticking with them as an audit firm?
Since Markham, the big news from the SEC and the PCAOB, Markham has lost about just a little over a dozen clients. But I will say that more than about half of them were very routine, and then other ones. One of them was very high profile, the Trump SPAC, Digital World Acquisition Corporation. That was aiming to take Donald Trump's social media platform public. They fired, or actually, no, Markham quit. We call it DWAC here in the newsroom, but they quit DWAC, and that came out, and Markham basically said like, well, we decided to quit after your separate. They had a fine from the SEC as well for unrelated reasons. So they were like, auditors don't really like to have risky clients. So they were like, bye. So those have been, I guess, a really long way of saying, Catherine, that I haven't seen anything unusual in terms of clients dropping Markham.
Well, if you wanted to switch, what are your options?
If you're a SPAC?
Yeah.
Well, the other auditor is with them. So you could do that. I've seen a few smaller, like mid-tier audit firms. I'll just tell you though, there isn't that much SPAC activity, period, right now. Like the market has really, really dropped. Interest rates are sky high. SPACs are kind of like, people kind of see it as a little bit of a has-been market, like it was so exciting in 2020 and 2021. All these buzzy companies went public, and now there's like this glut of the blank check firms out there trying to meet a deadline to find a private company to acquire, and the reality is like it's an ever shrinking pool. So it's just there aren't that many out there, so they're just not as much actively seeking an auditor, I guess. But I have seen some other mid-tier firms become SPAC auditors, UHY, BF Borgers, Adeptus Partners. That's the one that took over Digital World Acquisition, or DWAC.
If I had to hazard a guess, I would actually say this doesn't impact Markham that much. Admittedly, I wasn't as familiar with Markham until this whole issue came up. But if you want a Big Four name, it's probably for different reasons than what a SPAC is looking for when it comes to, hey, we just need somebody who knows the accounting, has done this a million times, and can kind of rinse and repeat as efficiently and inexpensively as possible. So I would assume that doesn't change it. But then when you get to that D-SPAC, when you do need the new auditor, that's probably when that new company might consider, okay, do I want a Big Four name behind my audit? Because I really care what people think about me.
Exactly. And that's where you see a lot of the firms, so the Big Four basically did not touch SPAC IPO audits, because why would they need to, right? SPAC audits were much, much cheaper to begin with, because when you think about it, like a SPAC is just a bag of cash. Like, it doesn't have a building, there's no employees, there's no tricky intangible assets you have to worry about. Like, in theory, it's a very simple audit. Like, and that's kind of what landed Markham in hot water. The SEC did not use the phrase copy and paste audits, but it basically described copy and paste audits. Like, again, another, very exciting part of the enforcement order says, like, the memos that they provided for audit documentation, a lot of them didn't have the name of the client on it, didn't have the date, didn't have the name of the partner. Like, it was kind of like, I don't know if anybody photocopies anymore, but like, they were handed around and like very simple because they all had very, very similar structures. So it was supposed to have been simple, and it just wasn't. The Big Four did not touch them, but the Big Four went all in on the companies that eventually became those that were listed on NASDAQ or the New York Stock Exchange, et cetera.
One of the other things that we'd also heard relative to SPACs is just that the SEC, from a regulatory standpoint, is making them less appealing, is sort of taking away some of those perceived benefits. So it sounds like, in addition to maybe some of the market cooling, Nicola, is it also just a function of the SEC, layering on a lot more scrutiny to SPACs to where the benefits just aren't there anymore?
100%. So the SEC last year proposed regulations about SPACs, and they haven't finalized it. And they did put that they're going to finalize it in October. But I think the market's kind of like, are you really going to finalize it just because, there aren't that many SPACs? But the proposal put a chill on the market because, people who were interested in SPACs were like, whoa, this is what the SEC is considering. And here are all the liabilities that could happen for me. And here's where I could get in trouble. I might want to back away from this.
In the meantime, we have a closing question for you, Nicola. So in my head, for your job, you probably have to go to a lot of SPAC conferences. What is it like to go to a SPAC conference?
Yeah, so I only went to one. I usually go to accounting conferences, which are like extremely, they're not that exciting. The SPAC conference.
Come on now. Are you just really...
Except for Amplify.
Yeah. The SPAC conference was really fun. I went the summer of, I guess it was 2022. It was like kind of fancy country club. There was a champagne bar, a beer truck. It was pretty lit, as one would say about a conference. It was very, very different from the kind of thing I usually go to. And it was just so fascinating compared to the buttoned up kind of nerdy world of accounting.
Are you allowed to partake in the champagne and whatnot?
I did at the end of the day, I did. There was also a hand-rolled cigar table, but I don't like cigars, so I did not partake in that.
You might as well just be describing the off-the-books employee Christmas party that we had not too long ago, so Interesting the parallel there.
Yeah, definitely not the Bloomberg holiday party experience. Well, we don't have one, so...
There you go. Well, thanks, Nicola, for being with us.
Thank you, Catherine. Thank you, Steve.
Yeah, definitely thank you for dropping by and for your insights. And thank you, dear listener, for surfing along with us. I'm Steve Soder, that was Catherine Tsai, and this has been a bonus episode of Off the Books, presented by Workiva. Please subscribe, leave a review, and tell your buddies if you like the show. If you're watching this on YouTube, please, we would love to hear from you, so leave a note in the comments, or feel free to drop us a line at offthebooks@workiva.com. Surf's up, and we'll see you on the next wave.